Hello everyone, I'm Florence Boix, Deputy Head of Client Management for Private Equity and Real Estate Solution at CACEIS, and I'm today with Stephane Barret.
Good morning, Stephane Barret, Head of the Private Capital Group at Agricole CIB and Head of TMT Coverage.
We are very pleased to welcome you back after summer in this very first day, just 1 week before the IPEM. This last quarter of 2024 promises to bring many uncertainty and maybe surprises, and both at geopolitical and economical level. So today, let's have now first a global outlook with Stephane on the threat and perspectives that will influence the private equity market.
Thank you. So what are we talking about? We've been expecting 2020 to 23. 24 was supposed to be a great year. Well, it's not quite there yet. So what's happening in the market? I think that there's a lot of uncertainty. I think people really don't know where we're going. We have geopolitical uncertainty. In France, we have just pure political uncertainty. I mean, nobody really knows what's going on. And I think that's affecting the general mood of CEOs, of investors. People want to know that if they put good money to work, they can get good returns, right? That's the basis of the business. And so all this has created a lot of uncertainty. We were expecting interest rates to come down a lot earlier. They did not. So maybe now this time is going to be the right time, knock on wood. Maybe we will get there for the first time. And so this should create some kind of a momentum that will bring investors back to doing some deals. But portfolios are huge. M&A is still sluggish. Growth is not there. And as a matter of fact, in some countries, we're talking again about recession. So that implies a completely different skill set for investors in terms of management of portfolios, seizing opportunities, and what are the key sectors that you want to grow for. For example, tech has been very impacted since the crisis. There's a renewed interest for tech again, but for fundamental tech that has good profitability measures. All the old conditions in which people had a huge burn rate are off the table. So that's what I mean by some very easy to understand examples of what fundamentals need to change in the industry. But we still are hopeful. I'm very optimistic by nature. That's why I'm still around, guys. And so what we see is that we think this will grow. The debt markets are good. The high yield market is wide open. We have debt funds. We're supplying lots of debt to the market, but also the banks are there. And we think that as time goes by, LPs will come back to the market. We'll continue to put more money in the industry. And we have other alternatives. We have retail. We're going to speak about that in the future. And we have other smart ideas coming out. We've spoken a lot about ESG in the past. Now we talk about climate funds or carbon funds. So the industry, like always, is adapting to its environment. So with that, in that context, how can sponsors overcome the moment and what propose long-term strategies to investors?
Yeah.
What is your view, Florence?
About long-term perspective, by essence, private equity is long-term. So thanks to this kind of strategy, investors can overcome the moment and avoid the current turmoil of the context.
But if we consider stability, what could be the main solutions coming up?
I think that diversification and flexibility are keys because with a prudent diversification of portfolio, investors can mitigate their risk, and also through tools of stress test and risk assessment, they can avoid the shocks that could impact the different geographical zones they are invested in and sectors. And also, for that reason, they will use this tool to diversify their portfolio and the region they are invested in.
Okay. But even then, I think that even when we those kind of situations, for example, healthcare has been a big sector for financial sponsors. But now we see that healthcare is becoming, well, not so promising anymore, you know? So I think we have to put a little pinch of salt on diversification. And so what kind of sectors are we really talking about?
Well, I think resilient sectors that have proven to be resilient during the pandemic and during the beginning of the Ukraine and Russian war can be an option. And in particular, I thought about technology and renewable energy. Yep,
absolutely, absolutely. And ESG and all this. ESG, when we were speaking a bit about it earlier in the beginning, it's a main driver. And if you don't have an ESG strategy, you're not going to get any money, guys. I mean, let's just keep it very simple. Investors are requiring you to have an ESG follow-up, ESG review of your portfolios and key targets that are ambitious enough to show that you really care. And in a nutshell, I think that's the way we would consider the ESG strategy in the market. And so we've seen some people move to diversified ESG strategies, like I was mentioning earlier. Climate funds, everybody has an impact fund, but not everybody has a climate fund. And I think a lot of them are coming to that view that you need to diversify the amount of investment strategies that you're offering to investors in order to attract them, attract their funds, and still maintain, as you were mentioned earlier, that diversification. So I think we'll see what ESG, but I think you can agree that ESG is just must-have if you don't.
Yeah. Today it's the future, and I think it is also less correlated than other traditional asset classes.
Yeah,
so
investors,
and in the end, will be a very lucrative exit. And I think the combination of market fundamentals with supportive regulatory environment.
Yep.
And for strong technological advancement may lead to robust return, and especially in the end, when the companies grow matures, the lucrative exit can succeed through IPO or acquisition. So I think it's a target that can be avoided.
Sounds good. And for the current portfolios, any way we can enhance resilience?
Yeah, I think there are three ways to enhance resilience: through supporting existing portfolio companies and use dry powder in a very strategic way by preserving capital to seize the best opportunities to consolidate the portfolio, or support existing portfolio company when they promise to be.
I think clearly I agree with you that on those points. I think that portfolio strategy is going to be at the heart of this GP strategy for the next 12 to 18 months. As I mentioned earlier, portfolios are bloated. Doing deals is difficult because of a number of, we have competitors from trades. We don't have the IPO market yet as a competitor, but just deal flow is very low. So what is expected from LPs is for you to do is to take care of that portfolio. I would call it the gardening strategy. You have a garden, take care of it. Don't give it to somebody else, don't farm it out, don't carve it out or reinvested it in a new deal, whatever, don't roll it over. Take care of it. And the best way to take care of your garden is to, obviously you have good management, but also to do the right acquisitions to grow your portfolio, grow your garden. Put in new technology, change the strategy of the business, to be more expansive, go into new geographies, new products. That's what I think investors are expecting you to work on your portfolio. And when the time is right and the EBITDA has grown sufficiently, even if the multiple has compressed over time, you can still offer good returns to your portfolio. The IRR will not be there, but the cash-on-cash multiple will be there. And I think that's really the fundamental issue that LPs are expecting from GPs in the portfolio management.
Yeah, you're right. So among the strategy to overcome crises, we have mentioned the asset class diversification, and among the asset class, the private debt has known a very good success over the recent year. So to your opinion, Stephane, what criteria have contributed to gaining investors' confidence?
Well, listen, I think the first part is when you look at the environment of dislocated markets. Anytime there's a dislocated market, and the banking market in 21 was completely dislocated, that's an opportunity for investors. And some people had a lot of technical good credit background, and they said, well, maybe we can increase the speed of rotation in which we are exiting the banks from the investment market, and we're taking the place. And so since the beginning of the Ukrainian crisis, we've seen a fantastic growth of credit funds, not only because of the dislocation in the market, but also because of the increase in rates. The increase in rates gives them a good basis from which you're going to make very good returns. Okay, when you're looking at 8%, but you already have a 4% embedded because of the cost of money, you can ride pretty good. Okay, and so what happened is that we saw a fantastic growth, and I think the growth that we've seen for private credit has exceeded any expectations. I think it might be a bit too much. I think too many people invested in credit funds, but it works extremely well. They're smart people. Once again, they're looking at portfolio companies and LBOs. They're buying portfolio companies. They're looking at mid-caps. They're looking at new strategies, refinancings. There's a whole array of situations in which they can get involved, including for banks. We call that capital relief funds. I'm sure you all know about that. Banks have a problem on Basel IV. They have a problem about balance sheet exposure, cost of money and balance sheet. Well, funds were created to give banks some relief on capital relief. So all these different items, multiple smaller strategies have grown really well. And we've seen the largest funds getting created now. RS just launched a new fund. They're targeting 35 billion for the latest credit fund, which is unheard of. I mean, these are huge funds. So because of all this, I think that there's been a lot of attraction, a lot of interest for debt funds.
And what about returns?
Well, the returns have been excellent. They've been able to price whatever they wanted. The market was empty. All the banks were not there. And so the returns are juicy. Now, question is, are we on a downslope?
Yeah.
That's the problem. When you go up, sometimes you go down. And so...
That could be my next question. What's the mitigation for the success of private debt funds? Do you see some weakness or sees? Or
Sure. No, actually, what we see is that we think that right now, debt funds have to kind of hurry up and put the money to work. And you can see it in the market, in which a lot of debt funds are being a bit more aggressive in their stance towards deal making. Whether they're buying a portfolio, whether they're financing a transaction, they have to put that money to work. And because they've raised the money, and if they want to raise the next vintage, they have to put this one to work under good conditions, deliver good returns. And so for the moment, returns are good. But now that interest rates are going to start coming down, banks are going to become more competitive. So the pricing of new deals is going to come down. Hence my comment earlier that we think, I'm still optimistic about the sector, and we think that business is going to pick up, but it's going to be against debt funds. That's why they have to diversify as well into new strategies. So that's what makes it a very interesting segment. There's always new things to be developed and grown. So Florence, what about CACEIS and debt funds? I'm sure it's a fantastic sector for you guys.
Yeah, no? We also have witnessed a very nice growth across the ultimate years. And for CACEIS, 10% of the assets under depository come from debt funds on the private capital market. On the whole business, and we are trusted by 4 on the top 20 debt fund asset manager in terms of asset under management. So it's a consistent percentage of our asset under depository. And now what we have seen across the ultimate year is that the market in 10 years have been multiplied by 3. So it's a very impressive growth. And at the beginning, all the debt funds were launched by specialized asset manager in debt funds. And since 2 years, we have seen more traditional PE actors entering this market and building their own range of debt funds to offer diversification, in-house diversification to their investors. Specifically in the French market, we have seen in 2019 a very strong will from the regulator to offer debt fund offer, because the regulator created OFS, meaning organism of financing specialized. So this fund come to re-emplace the traditional vehicles such as FPS and SLP that were traditional vehicles for debt funds, and to open the possibility of investment, because this OFS open to the European passport, and also the underlying sub-funds are very more wide than they were with the first structure. So it opened the possibility for GPs in France to create debt funds. And it links to the topic of ESG, where today there is an increasing need for energy transition, and debt funds are coming to finance it. And may expect a good exit, because there are many qualitative underlying loans on the market, and it's a positive issue for this kind of product. And to end, and maybe to make the following topics. Another element that I think that have contributed to the growth of debt funds is that they are fastly democratized. And it's a product that is easily understandable by retail, because they pay regular cash flow and work more or less as bond funds. So thanks to a technological platform that have arisen this latest year, they are more accessible to retails, and also through dedicated funds. And this is also a part, I think, of their success.
Interesting. But so retail, we've been speaking about retail for the past couple of years. How can we give confidence? How can they gain confidence and take part of this investment growth that is expected? How do you see that at CACEIS?
Retail at CACEIS, so we have all the part of listed retail, and for PE and private assets, we have seen a growing interest on behalf of the retail investors since a few years, And this is due to several factors. First, regulatory change that are in favor of retail and retailization of PE, because they have lowered the barrier to enter PE in several jurisdictions and created dedicated vehicles also for PE to retail. It's also the counterpart from the growing demand diversification demand from investors, because they faced lower rates in the latest year, especially before 2023, and they were seeking for new investment and new type of investment. And to end, this diversification and retailization has been possible thanks to technological advancement that have increased accessibility. Fintech platform, facilitating the dissemination of this kind of funds. And to end, we have also two fund structures that are really done for private equity, which are LT funds, European long-term investment funds, providing private asset underlying investment with a part of liquidity, which is key in the distribution to retail. And also evergreen funds that are the new common, I would say, because they allow a day-to-day basis investment and disinvestment from the investors. And this is for retail also a key element in their strategy.
But every investment, every GP has their own dedicated retail, high net worth teams. Globally, we get called on a regular basis. As you know, we have Amundi together. So everybody wants to talk to Amundi, to the private bank, blah, blah, blah. But can we put some amounts here? Can we put some numbers on all this?
Yes, of course. It's a very fast-growing market. And in 2023 in Europe, the individuals market has risen up to 900 billion euro.
Whoa.
And a growing portion of this asset is now accessible through retail products. So, and we see a very strong tendency to design specific products for retail that can be part of existing products or totally new products, depending on the target of the retail. But also, now it puts a number of the percentage of private equity funds available for retail that have risen to from more 30% in 2023. And it's very notable to see this. It proves it is a growing market.
Okay. So what do we have a view of how much does retail represent in terms of overall private equity LPs, or?
It's 15% of the market now of private investment in Europe. And before it was 5%
it was
5
really
years
low,
ago.
Absolutely. So it's really tripled in the past couple of years. Absolutely. But I'm sure that there are a number of challenges, and I think one of the main ones, and we've all spoken about it, is LPs, they give a commitment, and this commitment is drawn over time, for example. Retail, you never know what happens tomorrow, so you might as well get the cash now. And if you get the cash now, then the GP has to do something with all this cash, no? So there's a lot of challenges that come with retail, and you have to take care of them, you have to inform them. It's a lot more people. I mean, how do funds manage all this?
You're right. These are the three main challenges because, well, by nature, PE is illiquid and risky. And so retail need liquidity and need to understand risk. So at this point, the main challenge involves in private equity to be able to educate the retail investors. And through that, they need to be transparent about what they do and give an information detailed, or I would say at the level of understanding of their new investors. So this is a work they have to do. They have to do this work also with the distributors because they do not only distribute directly, but through intermediary. So they have to educate the intermediary, to educate the retail investors, the final investors. And they need to be transparent enough, because then we can expect that the regulator will come and put a stronger look about what they do and demand more reporting, increasing operational costs for the GP. That it's what has happened in listed world, and it will be the same and even stronger considering the level of risk of this kind of funds. So,
and I think that's the general expectation from GPs. I think they all expect the regulatory environment to become a lot more stringent in terms of reporting, in terms of leverage, back leverage, profitability, carry going forward. See in the UK, there's a few tax laws that are being considered. And as you go more into the retail sector, you have to have that regulatory body that goes with it. But one question we were speaking about when we were briefing to each other, what do GPs do with all this cash? Because there's a lot of cash coming in. They don't have a cash management per se business. Is there any people that have put in place some interesting strategies to put this cash to work? I mean,
for the moment, I think thanks to the platform, it pulls the amount gathered.
Yep.
So they can expect to be able to invest the cash quite easily because they have gathered quite a big amount that is investable. And in other case, I think they will put the cash to work in a money market fund or short-term strategy, because also in this kind of funds, we have to bear in mind that there is a need for maintaining liquidity.
Of course.
So the GPs will have to deploy strategy for short-term investment in order also to be able to give back the cash when necessary to the investors.
Interesting. So we just might see the beginning of some synergies between the asset management world, the way we know it, and the private equity or financial sponsor world, in which you're going to have to manage that fringe of funds and people in the retail sector, which are in between.
Totally.
Maybe we see a joint venture come up this year, some rumors of joint ventures. Okay, well, listen, I think that would be fantastic. So what about the distribution framework? How do you see that going forward? Because this really is a big investment for GPs. They don't all have the money, the resources to do it. How do you see this going forward?
I think the distribution network is key, and for the moment it's under construction, because as we've mentioned, it's a growing tendency. So it's at the beginning for the moment to design for GPs a different vehicle and strategy according also to the final retail type of investors, because we can have high net worth individuals, but also a wider base of retail and smaller investors. So the operational framework will be different according to the kind of investors. And at CACEIS, we see different projects, and across the last months we have seen many projects coming from many GPs.
Okay.
So we really see a very recent tendency, I would say, that is accelerating to launch hybrid funds. And here I think the first concern of the GP is to define the right transfer agent model. So they need to address different kind of retail, and for that different kind of framework are possible. So for the moment, what we see in terms of kind of structure, of preferred structure from GP, is co-investment fund, or also an evergreen funds that really is a distribution, because you can go in and out at every moment. So we see periodicity of valuation more frequent than for traditional private asset funds, and to be able to subscribe monthly, for example, where normally it's quarterly. So this is a very good difference.
I think it was good outlook, huh? Good outlook.
And well, for us, we are at CACEIS, when our clients come here to now, it's to define models. And what I would like to say is that CACEIS is very top level in terms of transfer agent for retail funds. We are used to many high volume of subscription and redemption and retail investors. So we have the tool and expertise to be a partner for our clients in this moment. And now it's what we are trying to define the best and suitable framework for the GP for the dissemination of the retail funds.
Okay, great. So, words of conclusion, words of wisdom on CACEIS with our clients. Any conclusions you want to share with us?
Yeah, well, in conclusion, we have dealt with many topics. We will be at CACEIS, we will be at the IPEM next week, and it's a very specific IPEM for us, because it's the first time after the completion of the merger with the European activity of 𝗵𝗶𝗀 in Europe. We are now one CACEIS, and we will be welcoming you with all the coverage team next week at the IPEM. because now CACEIS, it's a staff of 7,000 people worldwide, and 750 people dedicated just to private assets. So like 10% of the staff is just dedicated to this passioning world of private assets.
Fantastic. Thank you, Florence. So, team, I think you've heard it directly. If you haven't met the CACEIS team at IPEM, the door is wide open. We have a little coffee machine, and you cannot miss us at IPEM. We've been there every year, come the September or come the January show. So come and see Florence. We have great ideas that we're happy to share with you in terms of strategy. And as we mentioned earlier, Groupe Crédit Agricole is your partner to grow the business of financial sponsors. Whether it be CACEIS, whether it be CACEIS, whether it be the other entities of the group, we want to partner with you. We've got lots of ideas, lots of suggestions. The world is uncertain, but we never make as much money and we never take as much fun in our business than in an uncertain world. So come and see us at IPEM next week. We got some great things to talk about, and we look forward to seeing you soon. Have a great day. Thank you very much.
Thank you. Bye.